Good morning, everyone, and welcome to this August Future Influencers event. I'm John Wilson. I am Head of Technical at Dalriada and your chair for today. Just before we get started and I introduce the speakers, just a little bit of housekeeping first. The format for today's event is Teams Live. So whilst you'll be able to hear, obviously, all your speakers and your chairperson, just to keep background noise to a minimum, we cannot actually hear attendees, but that does not mean that you cannot participate in the event, and indeed we do hope that you will engage. So hopefully on your screen you will see that there is a question and answer option. And if you click on that and want to post any questions or other observations, then I will pick up on them throughout the session. If they are specific to a particular session, I'll probably deal with them at the end of that session. But there'll be plenty of time to ask questions of any of our speakers right at the end of the event as well. So please do get involved. And that takes me to the agenda today. So we have 3 speakers today. First up is going to be Graham Cunningham from Dalriada, looking at the future of trusteeship. Graham will hand over to John Walters, who is a partner at Evershed Sutherland, and he is providing an overview of the Section 75 employer debt regime. And then John will pass over to our own Angela Stokes from Dalriada, who is looking at the deferral of deficit recovery contributions under defined benefit pension schemes. Now, seems 3 quite disparate topics, but probably all very relevant during the current pandemic, because obviously governance of pension schemes is very, very relevant. We are seeing a growing number of employers approaching the trustees, asking to do things around deficit repair contributions and indeed ongoing contributions. Employers obviously struggling on some occasion and looking to pension trusts for support. And regrettably, as we start to transition out of the current pandemic, just looking at some of the headlines today, such as the job losses at Marks and Spencer's, it seems inevitable that not all businesses will survive, and that may lead to an increase in employer solvencies. And should these employers operate defined benefit pension schemes, then that will trigger Section 75 debts. So we need to be up to speed with that current legislation. So with that introduction, I think I am handing over to Graham first and the subject of trusteeship. Graham.
Thank you very much, John. As John said, I'll be speaking today about trusteeship, looking a little bit about the history of trusteeship and hopefully concluding with some of my perspective on what I feel the direction of travel is. So it's fair to say, if we can go to the first slide. Okay. It's fair to say that trusteeship is a rather old undertaking. If we go back to the Trustees Act of 1995, this was an act of Parliament which sought to update trustee powers and responsibilities and giving the powers to appoint trustees. So the world of trusteeship spins rather slowly. It was only just under 100 years later, we're now seeing moves towards professionalisation. In February 2020, the pensions regulator issued its response to a consultation on the future of trusteeship and governance. And this focused on 3 key areas. Next slide, please. So these areas were trustee knowledge and understanding, which in particular focused on an online learning tool, the review of the trustee toolkit, with the overall aim of making expectations clearer and to drive up the standards of trusteeship. There was focus on scheme governance structures, in particular trying to improve diversity on trustee boards and what could be done in that regard. to support schemes adherence to trustee. Thirdly, there was a focus on whether or not to make it compulsory to appoint a professional trustee to each individual trustee board, which in my view would have been a bit of a game changer, quite frankly. In the end, it looks like the pension regulator has steered away from making widespread reforms, instead choosing to focus on the trustee toolkit and developing the accreditation process. Next slide, please. So there exists two frameworks for the accreditation process, two very similar frameworks, the Pensions Management Institute and the Association of Professional Pensions Trustees. Having checked yesterday, there's around 178 fully accredited trustees using the APPT scheme, and I think there's around about 30 or 40 or so under the Pensions Management Institute. The accreditation process involves trustees having to complete the online learning tool, as I spoke about, the trustee toolkit, and being able to display industry experience together with independent references. And there are some exams focusing on hard skills and soft skills. So a trustee of a pension scheme is expected to display what's known as hard skills. In other words, being able to display that they have a firm technical grounding and provide evidence of this. Clearly, exams are one of the best ways of evidencing that. But there's also soft skills. My colleague, Adrian Campbell, spoke about this recently at a similar event to this. And these include having strong interpersonal skills, being a good communicator, being organised, trustworthy, being able to display independent thinking, and also challenge advisors when appropriate. I think overall, the accreditation process for a professional trustee seeks to ensure that trustees of pension schemes act with integrity and they live by high standards expected of a professional trustee, which in itself is a big responsibility. Now, clearly, there would need to be a continuous review of this accreditation process to ensure that it continues to maintain relevance and to ensure consistency and quality. It is likely, well, trustees themselves have to display continuous professional development. They have to record a certain amount of hours every year, displaying that they're continuing to learn, and they have to provide evidence of this. It is likely that the pensions regulator will review the accreditation process sometime next year, and part of that will be trying to establish how many trustees have actually got through the accreditation process. Next slide, please. So I spoke earlier briefly about moves to improve diversity on trustee boards. Perhaps professional trusteeship and trustees of pension schemes has been viewed as something for the select few. But recently, the pension regulator's methods for updating trustee knowledge and understanding, in my view, looks as if it's seeking to reduce the barriers for participating in trusteeship. One of the reasons that they perhaps steered away from making it compulsory to appoint a professional trustee on every single board is perhaps there was not enough capacity out there. In other words, there weren't enough professional trustees in existence. So perhaps the accreditation process is one way of trying to address this. In terms of diversity on trustee boards, it shouldn't be seen as a nice to have, but perhaps it should be seen as a necessity. Early studies have already proven that more diverse trustee boards appear to have better decision making and higher quality governance. So it's possible that the regulator will stipulate a future requirement for schemes to report on steps that they have taken to improve diversity on their trustee boards. And the argument is this improves the relevance for members. What does this mean for lay trustees? I think they still play a big part in the future. Lay trustees bring to the table a historical insight to the scheme and also a familiarity with members. All in all, a diverse trustee board improves decision making and higher quality governance. For sole trustees, Dalriad itself, the company which I represent, operates a team-based approach to sole trusteeship, which in my opinion brings to the table a diverse range of skills and background. So there's less reliance on one individual, and this ensures continuity for clients and members. I'll move on to the final slide and give you a little bit of my perspective on professional trusteeship. I guess I viewed professional trusteeship as something that was previously unobtainable, something that was only open to former senior managers, those who had retired, or even long-serving employees. But now I can see a pathway, the accreditation process, and also the moves towards professionalisation. There's potentially a rewarding career there and an opportunity which perhaps didn't previously exist. I think most importantly, trustees, whichever background they come from, one of the most important qualities are the soft skills and being able to empathise with members and put themselves in members' shoes. Pensions are, of course, a minefield for many members, but all members still deserve value for money from their pension schemes. There's an opportunity now for someone like myself who recognisably is very early and at the very beginning of the pathway for professional trusteeship to put some of their experience and knowledge to good use. And that's my conclusion today. And thank you very much for listening.
Thanks for that, Graham. I think we're passing over now to John.
Yeah, thanks very much. Good morning, everybody. John Walters, a partner in the Evershed Sutherland pensions team, which basically makes me a pensions lawyer. I advise lots of trustees and employers and other organisations in relation to a whole range of pensions issues, but of over the years since I sort of started pensions lawyering, done quite a lot of work on Section 75 and the employer debt regime. And it always occurs to me that when you're looking at the current position and the current legal framework that structures and operates at the moment when you're advising clients or working with schemes or whatever, it can sometimes be quite helpful or even important or critical to actually understand sort of the heritage of the regime and to understand, particularly when you're involved with multi-employer defined benefit schemes, have a good understanding of why they are why they are currently where they are, what's happened and changed with the employer history over time. And so the idea behind my session today was really to give people a bit of a potted history Section 75 employer debt regime overview, and to do that sort of by reference to a timeline, which I will come on to in a moment. I sort of recognise that we've probably got people on today with a varying degree of experience and involvement with defined benefit schemes in Section 75, and so I'm not really trying to get right into the weeds of all of the technical stuff, but instead to hopefully provide that potted history overview, which might then be useful for people when they're looking at how the current regime operates. And I guess the key point to note at the outset, I think, is we've moved from a time 25 years ago where employer debt legislation and an employer debt regime was virtually non-existent, not quite, but certainly much less regulation and legislation and legal requirements around that space, to one where today it's totally unrecognisable, and anyone who picks up the legislation and tries to get to grips with it for the first time could easily be forgiven for having a migraine or a headache. So it's very, very technical, and it's changed a lot over time. So we could just move the slide on, Caroline, please. Okay, so just to set the scene a little bit for those who might not be quite so familiar with work or the issues in this area, what we're talking about when we say Section 75 debts is effectively a legislative regime and framework which operates under the Pensions Act 95 and associated employer debt regulations. And what it does is ensure that those employers or groups of employers who have legacy or current defined benefit schemes, that they have to stand behind those schemes, and they can't decide to wind them up or terminate them and leave them in an underfunded position. So they have crystallised obligations to make payments to those schemes in certain circumstances, the aim being to prevent them walking away from those schemes and ultimately to ensure that as much as possible members get the benefits that they're promised. Now it's worth saying that before the Pension Protection Fund came into effect in 2005, we had a system where obviously we didn't have that safety net, but we also had old style employer debt regimes, which unfortunately did lead to quite a number of defined benefit pension schemes being wound up or abandoned or attached to insolvent employers, where unfortunately, because of the way the legislation worked, lots of members got a very small proportion of their benefit entitlements, or indeed in some cases they actually got nothing because of the way the assets had to be distributed at the time. So there was an awful lot of policy soul searching and thinking, I guess, which has led to where we are today with a much more robust regime. And if you're thinking, oh, how can this be relevant to different areas of work and advice and schemes that we all encounter? Well, of course, it applies to defined benefit and hybrid schemes that we work with. But there's a link in with Section 75 to employer covenant. So when people are thinking about who's responsible for this scheme, ultimately that often comes down to who is on the hook under the employer debt legislation, who remains an employer liable to fund this scheme. And that can be a very important point to get right when people are in the heart of restructurings or distress situations, or just in negotiations between employer and trustees. It's central to scheme funding for much the same reasons, who's on the hook to fund this scheme on an ongoing basis. And it can be equally critical to have a good handle on who's on the hook, who are the employers still for the purposes of this scheme when we're thinking about PPF eligibility or indeed future PPF entry, and who would need to go into an insolvency event within the employer group in order to trigger that safety net. So there's quite a few areas where this can crop up, and you quite often can find yourself looking at pensions projects or situations, and they're not obviously ones where you would be thinking about Section 75, but there is a Section 75 employer debt regime angle that's just very worth keeping in mind to make sure that something's not missed. Okay, next slide, please. Okay, so I think the way I'm going to sort of lead us through this session is to divvy up the last 23 years or so into 4 different periods, and I've noted those on the slide here with our timeline, and then we're going to have a slide in a moment which sort of deals with the evolution of the employer debt regime from left to right. I suppose what I'd say at the outset is the way that the employer debt regime has been built up over the last 23 years or so, it's all about, if you keep a couple of things in mind, it's all about in what circumstances might an employer suddenly become liable to make a significant payment to the scheme in respect to the deficit because it's crystallized a debt under the employer debt regime. So a debt becomes due in certain circumstances, and we'll come back to that. And then the other question to keep in mind, I think, is, well, how is that debt calculated? And as we move from left to right on this timeline in a moment, we'll see that that's changed quite significantly over the period, with the aim being to make employers much more accountable for standing behind the obligations in their defined benefit pension scheme. And the other theme we'll see is that as we go from left to right on this timeline up to the present day, things have got a hell of a lot more complicated, also a hell of a lot more robust, but there are also lots of additional options which have become available to employers and trustees when there's a situation where an employer debt may be crystallised or is crystallised. There are also a number of flexibilities within the regime that allow trustees and employers to agree how that should be dealt with. So we'll see how that develops as we move through the slides. If we can go to the next slide, please. So if we start off with our sort of broad brush first time period, which I've called pre-1997, I think probably there's not masses to say for this slide other than that before 1997, we had a situation where there was legislation which provided for debts to be triggered by reference to employer insolvency or scheme wind-up. However, there was very little by way of sort of real bite or teeth to that regime, because it's all very well saying that a debt's crystallised, but unless you put some detail around exactly how that's calculated or make it very prescriptive, it doesn't really have the same teeth or strength of regime that we'll come to see as we move on to the other periods. So the calculation basis before we had the Pensions Act 95 come into force in 1997 was much more informal. We had very little prescription around exactly how those debts should be calculated, and in particular there were lots and lots of gaps, particularly in a multi-employer pension scheme structure, which we obviously know is very, very common. So I think probably the key message for pre-1997 is we had a very informal regime which didn't really produce particularly satisfactory outcomes for pension schemes or their members, where there was an employer insolvency or a scheme was wound up and you had an employer who wasn't interested in fully funding those benefits. Okay, if we can move on to the next slide. So as we get to, if you like, April 1997, this is when we had the Pensions Act 1995 coming into force. And what we had for the first time from then was an additional debt trigger, which is particularly relevant for multi-employer schemes. So if you think about how a multi-employer scheme runs, when it's open to accrual, you may well have had one employer withdrawing from that scheme for its own commercial reasons, or indeed because it might be sold out of a group or something like that. And the worry that the government had, and they've not become any less worried about that, and I don't think the regulator is either, is that, well, before that employer sort of disappears from the group arrangement, wouldn't it be appropriate for them to have to make some sort of terminal payment to the scheme, so that you don't gradually have a house of cards where you've got a large scheme attached to a single employer at the end of the day? And so we've got a newly introduced debt event for multi-employer schemes, which is sort of in broad terms where that employer looks to withdraw from the pension scheme. You should do a test to see whether the scheme's in deficit and whether they should be making a payment. The problem initially with that, I think, is that these debt trigger events, so the first two we talked about plus this new one, were all initially operating by reference to the minimum funding requirement. So the MFR, some of you who've been around long enough or who do work in this space will know that the MFR is the old statutory funding standard that was repealed in 2005. And the problem, I think, really with calculating exit debts or terminal debts on that basis is that it was just simply too weak. And so even when people were liable for a debt, they tended to be small and were insufficient to actually get the scheme to a more secure position. And that led to some of the outcomes even after 1997, I think, where you had schemes being wound up or employers going bump, where members were getting only a relatively small fraction of their benefits. And so there was further governmental action, policy making led to things being tightened up. So between 2002 and 2005, we saw a gradual phasing of away from the MFR minimum funding requirement deficit test for these debts and moving to what we call the buyout calculation. I'm sure people will be sort of familiar with that term, but it's basically based around an assessment of the cost of securing benefits with an insurance company. So a much more stringent standard that would be designed to leave the scheme in a much more secure position on an employer exit or where the scheme's wound up, the aim being to deliver full benefits. From an employer perspective, of course, that's much more onerous. And so the transition from one regime to another created much stricter onerous obligations on employers. And that's why when I mentioned some of those flexibilities and alternatives at the start, those have subsequently been added in as a way of allowing employers and trustees to manage those obligations. And I will come back to that in a few minutes. The other, whilst thinking about what flexibilities are there within a defined benefit scheme at this point in time. There was in the legislation at this point an ability for the scheme rules to sort of interfere with the default legislative position. So rather than liabilities sort of being divvied up and debts being calculated just on the basis of the legislative position, it was possible for an employer's share of the deficit or their proportion of the debt at the time to be otherwise moved around or apportioned or calculated by reference to a provision in the scheme rules. So that last bullet point on the slide about scheme rules allocation is basically a reference to this alternative which existed at the time, which might mean that an employer didn't actually have to pay a debt because the scheme rules provided for that to be dealt in another way and for them to pay just a smaller debt. And at that point, up until 2005 or a bit later, schemes did used to use that. It's probably also referred to as a scheme apportionment rule, something like that. If you come across that sort of terminology, that's what it's talking about. Okay, if we can move on again, please, Caroline. Okay, so we're now skipping ahead to 2005, and by this point, as I mentioned already, some of those debt events that we've talked about led to the debt being calculated on a buyout basis. So we've got some of that already, but there's a further change which I'll mention in a moment. Just thinking about the debt triggers. So from 2005, the previous withdrawal event, if you like, from a multi-employer scheme that I mentioned, so where an employer decides to terminate its participation in the defined benefit scheme, what we had from 2005 was a little bit more prescription and definition around exactly what that meant. And it's at this point that we have a new definition of employment cessation event, which really for purposes of today, I just think about that as meaning that an employer ceases to participate in the defined benefit scheme. But you'll see that this particular definition is used quite a bit as we go forward, and I'll refer to it as an ECE sometimes as well. Okay, so we've got broadly the same circumstances under which debts would actually be triggered against sponsoring employers. And then we need to think about, well, what's the calculation basis? We've already moved to buyout for an insolvency event debt trigger and also for a wind-up debt trigger by this point. So there's much more onerous obligations on employers in respect of those events, albeit that in an insolvency situation, you would ordinarily quite often only expect to get a small dividend out of the insolvency process. And I guess the really important change here was from 2nd of September 2005. And this is when the employment cessation event, so the employer withdrawing from a multi-employer scheme, there we had the calculation basis changed from the MFR, which is that week-old basis that we talked about, and instead being updated to be calculated on the buyout basis from September 2005. And that was a very, much trailed, but very significant change to the regime, particularly where employer groups were doing restructurings and needed to be very mindful that if they did a particular restructuring or a sale of a subsidiary, which might trigger an ECE, an employment cessation event, the debt obligations that would be crystallized on that employer all of a sudden were a lot more onerous. The number would be, much greater on that employer withdrawal event. In terms of alternatives, so if you were going to trigger a debt via that ECE, and it would be calculated on the buyout basis, as we said, there did remain the alternative option of it being calculated by reference to a scheme apportionment rule or a scheme rules allocation provision. So there were ways which allowed employers and trustees to say, well, actually, is it sensible for that debt to be triggered in full, for it to be collected, for it to be crystallised now, or should we do something else? And that was something which was still at that point able to operate under pension scheme rules by agreement between trustees and employer. We also had a new concept introduced called a withdrawal arrangement. So in recognition by the regulator and the government that this was a new, more challenging, onerous regime for employers who triggered debts under the ECE event on the buyout basis, we had the introduction of withdrawal arrangements, which were basically a alternative but statutory way of managing that Section 75 debt. So it was possible for an employer to identify a guarantor under that withdrawal arrangement, which meant that not all of the debt had to be paid at that point, and instead you could have a guarantor step in, agree under the withdrawal arrangement to take on responsibility, and that was a way of those debts being managed in circumstances where everybody was happy that it wasn't necessary or appropriate to collect in full. They were used a little bit, withdrawal arrangements. I wouldn't say massively widely, but certainly I did advise on some when they were fairly new in this period of 3 years. And then I guess if we can move on to the next slide, please, Caroline. So bringing ourselves sort of slowly closer to the current period, between 2008 and the present, we've had relatively significant further changes to the regime. We've kept broadly the same debt triggers. So in terms of circumstances when those debts might be triggered, they're broadly the same, subject to a little bit of tweaking to the legislative wording and definitions. We were already at a position where we had, for the most part, calculations being done on the buyout basis, so by reference to the cost of securing benefits with an insurance company. But in and around those two sort of central points, there's been quite a lot of other changes. So I'll just go through some of those. And as we do this, there's quite a few sort of technical terms or acronyms that we use. And I've tried to put some of these on the slide. I'll go through them now. So I've talked about the definition of an ECE, or an employment cessation event. And in the past, this started out as a definition which sort of talked about an employer ceasing to employ persons in the category or description to which the scheme relates. And anyone who sort of listens to and hears those words think, well, what on earth does that mean to somebody who just sort of speaks plain English? It's not very clear. And what we had from 2008 onwards was an updated definition of employment cessation event, which was much more closely pegged to an event which happens when an employer ceases to employ active members when another member continues to do so. So if you think about an open DB scheme, it's much more easy to spot with certainty if somebody ceases to employ active members when other employers in an open scheme still are. So that was one of the key and important changes that happened. I talked about scheme rules, allocation provisions or apportionment rules, and those were effectively withdrawn as a possibility from 2008. So lots of schemes had taken advantage of those and were using them, particularly in big multi-employer schemes. But from 2008 onwards, they were no longer available as a way of managing the Section 75 debt or doing something other than just paying it off in full. There were some transitional provisions which applied up until 2009, but they're sort of quite specific to schemes that were already doing stuff. And then thinking about other options available to employers and trustees in and around this space when a debt is or might be triggered on an employment cessation event, we had an expanded definition of withdrawal arrangements or availability of withdrawal arrangements. So we now have withdrawal arrangements and also approved withdrawal arrangements, the latter requiring the approval of the pensions regulator. And those operate in slightly different ways and require slightly different payment bases for the exiting employer. But they sit within that space, and effectively we've ended up with a sort of a parallel regime of two types of withdrawal arrangements. In my experience since 2008, they haven't been that widely used, not been that attractive, I think, to corporate groups and employers and trustees to use them, but they are there and available. And you might, when you're looking at a scheme's history or employer history or Section 75 history, come across to circumstances where they have been used. I talked about the scheme rules allocation provision being withdrawn, and effectively that hasn't just been withdrawn and nothing's come in its place. What we've had between 2008 and 2012 is a series of new statutory mechanisms to deal with Section 75 debts. I've grouped these as apportionment arrangements generally, but from 2008 it became possible to enter into a scheme apportionment arrangement, or an SAA as I've called it on the slide. That was the immediate replacement to allow people to do things similar to what you would have done under a scheme rules allocation provision. At that time, we also had the introduction of a regulated apportionment arrangement, and these were very much targeted at distressed insolvency situations. There's a sort of an approval and clearance process attached to regulated apportionment arrangements, or RAAs. But they came into effect from 2008, so you could have schemes where those have been done, particularly in and around PPF assessment and that kind of thing. And then from 2012, I think the regulator, policymakers and the government recognised that the regime with SAAs, or scheme apportionment arrangements, which came in from 2008, wasn't entirely perfect. So they created us another new species of apportionment arrangement called a flexible apportionment arrangement. And again, those are all about finding a remaining employer in the pension scheme who's willing to take on the liabilities that would otherwise be crystallised and become payable from that exiting employer. And flexible apportionment arrangements came into effect from 2012. And they've, in my experience, largely replaced the use of scheme apportionment arrangements. So in an ongoing scheme where you have an employer withdrawing, perhaps as a result of a restructuring or a corporate sale, it would be a flexible apportionment arrangement that would very commonly be thought about and used if all parties were in agreement. And then a couple of final points just to pull out as well. I've got reference on the slide to periods of grace as a concept which came in from 2008. And what these were was again, a statutory mechanism where if an employer had got to the position where it was going to experience an ECE, that cessation event, or had, it could actually serve a notice on the trustees saying, oh, this isn't actually the end of my relationship with the pension scheme. Please can I have a period of grace? I expect that I may have employees coming back into the scheme again in the future. And as long as they do within a period, then that allows the debt regime to treat them as if they hadn't actually crystallised and triggered that debt. And that can be quite an important facility for some employers if they have effectively inadvertently triggered that debt, or just done it by sort of staff attrition or something like that. It does give them some flexibility, and that's been used a little bit. And then more recently, we have what are called deferred debt arrangements, or DDAs. These are the newest concept from 2018, where an employer who has or would have triggered a debt can actually agree with the trustees that they'll continue to be treated as if they haven't, and therefore remain on the hook as a statutory employer under Section 75 and for other purposes. And therefore it sort of creates a slightly sort of technical situation where the employer avoids having triggered that debt but remains on the hook, so they're not released in the way that they would have been under some of those old regimes where they just walked away from the pension scheme. So there's an awful lot. It's been a fairly complex evolution, I think, to get us to the present day. It'll probably keep changing a little bit from time to time, perhaps, but I think we've now got a much more sophisticated structure, which from a policy perspective and a government perspective has really made the obligations of employers to fund and stand behind their defined benefit schemes much more robust, whilst trying to provide some flexibility as well. Yes, back to you, John.
Thank you very much, John. And I think we're going to continue with the funding theme now with Angela Stokes. Angela?
Yeah, thanks, John. So good morning all. I'm Angela Stokes and I'm an accredited professional trustee at Darwiada. So this morning, in light of the continuing challenges to the pensions industry due to COVID-19, I'm going to spend the next 15 minutes or so speaking about requests for deferral of deficit repair contributions, which have been raised by numerous employers during the course of this year. So I propose to firstly run through some points within guidance provided by the regulator in March of this year and their subsequent update in June, before running through an interesting case study which have been involved this year, which maybe puts it a little bit more into practice. And finally, I propose to close by speaking briefly about the issue of conflict management for trustees when faced with these kind of situations. So if you could move to the next slide, please, Kaz. Thank you. So trustees are the first line of defence for members, and have a duty to protect members' benefits at all times. And particularly during unprecedented circumstances of COVID-19, this is more true than ever. However, trustees also recognise with that the strength of the sponsoring employer is paramount to the successful ongoing running of the scheme. So the economic impact of COVID-19 still remains unclear, but the regulator also has been concentrating on the highest area of risk to schemes, which they too see as the employer covenant, i.e. the strength of the sponsoring employer. So in March 2020, the regulator released guidance for trustees of DB schemes whose sponsoring employer is in corporate distress. And in that guidance, trustees were advised that no action would be taken regarding failure of sponsoring employers to pay deficit repair contributions over the next 3 months, i.e. to June 2020. So noting that many employers are likely to request this suspension or reduction of contributions, trustees were expected to consider such requests with the benefit of full information regarding the employer's covenant prospects and also affordability for the employer. And what this meant in practice was that trustees have been expected to have access to information including cash flows and forecasts to understand how the employer has been impacted by COVID-19 and the continuing consequences of COVID-19 in the near future for the employer. In the absence of any clear covenant visibility in the short to medium term, the regulator expects trustees to offer only short-term concessions up to 3 months until more reliable covenant visibility became available. So, in addition, trustees are expected to have regards to the steps being taken by other creditors when agreeing any concessions to ensure that equitable treatment amongst all stakeholders is undertaken. The guidance lists questions for trustees, which they should be asking the sponsoring employer concerning the impact of COVID-19 on its business and the employer's ability to meet scheme commitments. So if we could have the next slide, please, Kat. Thank you. So the guidance issued in March 2020 included key principles for trustees to keep in mind when considering requests to delay deficit repair contributions. So those principles are listed on the slide, and I'll just go through them in a little bit of detail. So the principles which are expected to underpin any consideration of any request are trustees are expected to consider any request carefully to ensure that the support given is part of a coordinated and fair response across key stakeholders. So what that means is the scheme shouldn't suffer disproportionately to other company creditors. Establishing the need for the delay, so this includes ensuring that payments will not be made to related entities or shareholders during the period that the pension scheme's not receiving the contributions. Ensuring all parties are playing their part. In particular, where other parties are strengthening access to employers' assets through security, trustees are expected to ensure that the scheme's given their fair share of the new security, and also trustees should consider putting in place agreements to prevent new dividends or intragroup loans being introduced. Build in flexibility to restart the contributions. So any suspension is expected to have an end date and potentially to have triggers to restart contributions sooner if trading returns to normal. And where timescales for considering requests are short, any concessions should be for short-term deferrals. This enables information to be provided later for a more considered decision and potentially extending the deferral if the information received is sufficient. And in addition, the regulator suggests that trustees should obtain covenant and legal advice from advisors with experience of corporate distress and restructuring to help them with their decision. So if we could have the next slide, please, Kaz. Thank you. So in addition to those principles for considering a proposal, what should a successful proposal look like? And within their guidance, the regulator sets out key components of a successful employer proposal, which include transparency and ongoing information. So this means that open engagement between employer and the trustee with as much meaningful information as is relevant. Predominantly, that would be short-term cash flows. The initial request should be clear on what extent of deferral is being requested, as well as the rationale for the deferral and a proposed time scale for recommencement of contributions in the future. It's been typical for 13-week cash flow projections or longer to be shared, and most employers have been making use of pre-existing financial information prepared for other stakeholders, such as the banks. There's an expectation that a greater information flow than may have been typical will continue during the period of deferral to ensure that the transparency continues. Postponement of dividends. So dividends are expected to be postponed, and an appropriate switch on mechanism, so to speak, agreed, which typically will prohibit recommencement of dividends to shareholders until the deferred contributions have been repaid to the scheme. The movements in intercompany balances are also viewed as like a potential source of value leakage, and appropriate restrictions and checks should be considered by the trustees. Another key component is the equitable treatment with other creditors. So other creditors should be sharing the pain equitably with the scheme. For example, banks should be expected to suspend loan repayments whilst the scheme's not receiving contributions. And the regulator suggests that it might be helpful for trustees to align the timing of any deferral with support being provided by other stakeholders. Examples of wider cash flow management, for example, cost-cutting measures across the business, are also useful to demonstrate to trustees how the burden's being shared across the board, and to provide an illustration of the extent of any liquidity constraints of the business. Objective recommencement of deficit repair contributions. So the regulator states that where information is limited, any deferral should typically not have exceeded 3 months. However, it also notes that where other creditors, such as banks, are agreeing to longer deferrals, then it can be appropriate in those circumstances for trustees to mirror that. And again, reference is made to a switch-on mechanism, which enables contributions to recommence earlier than plans if the company's situation and cash flows improve faster than expected. And that can be a useful tool for trustees who've agreed to longer deferral periods. Finally, sound independent advice. So a request to defer contributions is a significant decision, but the regulator recognises that deferrals of requests have been coming in compressed timescales. And whilst it's still more important than ever that employers and the trustees are well advised during the process, there is a recognition that the advice and the level of written communications may be more limited than other situations where deferrals would otherwise have been sought. So following on from that March 2020 guidance, it was updated in June of this year, recognising that suspensions or reductions may continue to remain appropriate given the economic situation. However, in view of the improved visibility of employers' financial situations, because we've had a bit of experience, the regulator no longer expects trustees to just unquestionably extend original suspension arrangements on like a 3-month rolling basis based on limited information. It doesn't want these arrangements to become a new normal, and instead trustees are expected to undertake due diligence on the employer's financial position before agreeing to any new or extended deferral requests. So we could have the next slide, please, Gaz. So that was the regulator's guidance, but I thought it might be of interest to show an example of where this has actually been put into practice. So I've chosen deliberately a slightly tricky example that I've been working on with colleagues at Dalriada in an attempt to demonstrate how trustees make decisions in reality, taking into account that guidance. So in this particular example, Dalriada has been appointed as the sole trustee to a scheme with assets of about 200 million. I've been involved in the scheme for a number of years, so we know the business reasonably well and how the scheme works. So the sponsoring employer business relies heavily on advertising sales, in particular property, holidays, local businesses, etc. So unfortunately, all of the types of business which have been severely affected by the pandemic. Prior to COVID-19, the company had been looking at ways to improve its financial position, and the finance team were positive in their forecasts for potential growth, but the trustee was aware that this was a business that was not necessarily with the strongest covenant anyway. So as a piece of background information that's also important to this case study, it should be noted that the company had sold one of their properties at the end of 2019, and the scheme had been granted rights to 10% of the sale proceeds of that property. It hadn't been paid to the scheme yet, but it was promised and being held separately in a separate account, ready to be paid to the scheme in March 2021. So when COVID-19 hit, the company's revenue stream pretty much just disappeared almost overnight as advertisers pulled out and sales of the product just ground to a halt. The company did its best. It took advantage of deferrals of PAYE, national insurance contributions, VAT, etc. But it wasn't really a surprise to the trustee when the request for a deferral was received in March 2020. And the trustees agreed to that initial 3-month request to try to help out the company and to just give them some breathing room to assess the impact of COVID-19 on the business. So if we could have the next slide, please, Kaz. Thanks. And in May 2020, the company made a subsequent request to continue to defer contributions until October 2020. And then along with this request came an accompanying request for the trustee to release the proceeds of the property sale, which I've previously mentioned. The company did provide business forecasts along with its request, and it stated that the deferral would allow the business to trade successfully in these unprecedented times. And within that request, the company set out some key information for the trustees to consider. So this included the company has a banking facility, but it stated within its request it was currently reluctant to take on any additional debt, given that in the future, for financing needs of the business, it might want to rely on that. It stated that it had taken advantage of deferral of PAYE and national insurance, as well as VAT for Q2. And it said that the payroll payment for July 2020 would cause a significant strain on the company if the request for the deferral of contributions was not granted. And within its request, the company proposed that the scheme would rank with HMRC and the bank, with contributions to be repaid on an affordability basis from additional cash when it became available to the company in the future. So if we could have the next slide, please, Kaz. Thanks. So upon receiving the request, the trustees had some concerns, and the trustee engaged its own independent covenant advisor. Notably, when considering the request, the business's trading forecast pre-COVID, although improving, as I've said already, it already caused the trustee to consider the strength of the employer's ability to support the scheme pre-COVID. And so the proposal from the company just kind of consolidated the trustee concerns about the strength of the covenant and what they needed to do to protect the members' benefits within the scheme. So in summary, the main concerns of the trustee when considering this proposal from the company were that the forecasts and accompanying materials received from the company noted a breach of banking covenant anticipated to incur in March 2021. But it was also notable that the company hadn't actually commenced any meaningful discussions yet with the bank because of the reluctance of them to take on that debt in case they needed future financing. And so it occurred to the trustee that when the breach of the banking covenant were to occur, the scheme was going to be expected to release the balance of the property sale proceeds, resulting in a material improvement to the bank's position because they weren't being asked to finance, to provide any more finance, whilst the scheme would be losing out of its right that it held over the property proceeds. The scheme would essentially be suffering proportionately a greater detriment than any other creditor on this proposal. So all in all, by agreeing to the deferral of the contributions request and the accompanying request to release the property sale proceeds, the trustee considered the scheme would be suffering far greater detriment. And it appeared to the trustee that the company was nervous to take on more debt from the bank, which only reinforced and supported the trustee's concern about the strength of the company and its ability to support the scheme. So considering the advice of the covenant advisor and also checking in with the legal advisors, the trustee felt it was unfair that the company would only engage with the bank if the trustee were prepared to release funds over which it had a prior claim back to the general body of creditors, because the scheme would essentially become a key lender. Taking into account the regulator's guidance, the trustee wasn't convinced that the proposal fell within the remit of the guidance. It didn't consider that it would be receiving fair and equitable treatment alongside other creditors if it accepted the terms of this proposal. And so we went back to the company and requested an improved offer, requested that the company commence engagement with the bank, and also requested that the company consider further creditor referrals to reduce the impact on the scheme alone. If we could have the next slide, please, Kaz. Thanks. So in conclusion, it's perhaps unsurprising, given all of what I just said, that on further discussions with the company, the trustee couldn't reach a position where it was comfortable to agree to the deferral request until October of this year. The company hasn't made an improved offer, and additionally, it didn't pay its June contributions, which ought to have been received in July. So as a consequence of that, the company is currently considering its options for the future in terms of trading and also in supporting the scheme. And the trustee, the regulator and the PPF are all involved in those discussions. So if we could have the next slide, please, Kaz. So it's clear from that case study that dealing with these requests in reality is not as straightforward as, well, I don't think the regulator is saying that it's straightforward, but there really are key concerns that the trustee has to consider when weighing up its duty to the members and also its expectation, well, it wanting to support the employer as well. And when considering requests from sponsoring employers in distress, the regulator suggested in a recent blog from its CEO, Charles Council, that trustees should remain ready for a COVID-19 balancing act. Considering that more insolvencies are anticipated in the autumn and going forward into next year, companies will be considering restructuring, and trustees should continue to be open to reasonable requests from distressed sponsors to support for the scheme and the trustees to support restructuring plans, but also continuing to seek appropriate mitigations if they agree to such support. So it's recognised that in doing so, the trustees may be conflicted about their duty to members and the desire to support the distressed sponsor. And if this becomes difficult to manage, the trustees are expected to consider conflict management advice or bring in independent trustees with restructuring experience. And while the trustees may feel uncomfortable asking an employer to pay for advice at a time of financial distress, or indeed if the rules allow in paying those fees from scheme assets, trustees need to ensure they've got a good understanding of options if they're to support the business effectively without disproportionately disadvantaging their scheme. And one thing that stands out in the current times is that many decisions trustees and companies are faced with are completely unprecedented. And when considering options and how to act, it's likely that in the future some schemes and employers will have made the wrong decision. So a good rule of thumb is to consider that if hindsight should show the trustees that they've made the wrong call, the trustees need to be able to demonstrate that when taking that decision, they made an informed choice by obtaining all of the relevant information that they could, taking appropriate advice, particularly legal and covenant advice from people with experience in the restructuring arena, and making decisions in good faith and in accordance with the scheme rules. So that pretty much concludes what I was going to speak about today. Hopefully it's given a little bit of food for thought when advising trustees who are faced with difficult requests from distressed sponsors and consideration of conflicts that they face. So if you have any questions, as John said at the start, feel free to raise them in the question box, and I'll pass back to John Wilson now, who's going to field any question and answer session. Thanks, John.
Lovely. Thanks very much, Angela. No questions at the moment, but still plenty of time if anyone wants to make any observations or ask questions of any of our speakers. And just to give you a little bit of time to think, maybe I'll exercise Chair's prerogative and go first. And I'll start with you, Angela. So this all became very topical, this deferral of both deficit repair contributions and indeed future contributions. Started as we went into lockdown. We're now on the second iteration of the guidance, and we are on our way out of lockdown. At the same time as government support schemes like furlough are coming to an end. So can I just ask you a little bit about our experience so far in terms of quantum and frequency of requests, and what our expectations are as we transition out of our sort of working from home, and as I say, the things like furlough come to an end?
Yeah, so I suppose it's been quite interesting in terms of like my client portfolio and looking at the sponsoring employers. I think it does depend to a certain extent the industry which is sponsoring employers in. So we at Dalriada as a whole have been making it our business to keep in regular contact with the employers to find out where they're up to with their ongoing businesses, and how many people they're furloughing, when they're expecting to come back. And I have seen, unfortunately, a trend of many of the people who are furloughed are in now in business restructuring, like effectively redundancy situations. So I'm not sure in terms of like how many schemes will be continuing to make these requests, but I think it's still in the back of when we're speaking to sponsoring employers, even if they've not taken advantage of this for whatever reason, at this like the reduction, like deferring their contributions, it's still in the back of their mind as an option when they're trying to bring people back in. And we've also had a few conversations with employers about where they're potentially considering like I want to say lighter touch insolvency decisions, like with CVAs, or which is still big decisions for the company, but just to try and remove, I think more and more they're just trying to remove themselves from being associated with the schemes where they can. I'm not sure if that answers your question fully.
Yeah, so I think it does, in the sense that we've not seen the end of these requests, and there's probably many more in the pipeline as well. And maybe sort of in a similar vein, John, if I can turn to you and just speak about a little bit about the COVID effect and interaction with the Section 75 employer debt regime, to the extent have you been asked to advise on more triggers? Are you seeing employers in multi-employer schemes who want to try and get out of that scheme, but appreciating that could trigger debts, and looking for advice on how they might manage that debt as well? Is this an area that your firm is getting more inquiries about?
I think to answer that question, I think I'd say we always have stuff on where we're advising on different aspects of Section 75, whether it's linking into sort of employer covenant reviews and helping people to understand who's on the hook, or whether it's a restructuring, or it's managing some of these things in the context of a benefit change exercise. So we've got some and all of those things going on at the moment. I suppose what I might say about the sort of pandemic and COVID is that I think if employers were sort of looking at some of these things and thinking, oh crikey, I'm in this multi-employer scheme and it's a bit of a nightmare and I'd quite like to get out, I suspect actually the effect of the pandemic and COVID might be that they've sort of put that in the deep freeze, or more likely to have put it in the deep freeze, because they're probably thinking, well, we've got a million other things which we need to try and sort of handle and face and mitigate in the short term. So I suspect that those sorts of projects are still happening, but in some cases people would actually say we've got much more high priority business critical stuff to manage, and it might be more around what do we actually do about the short-term deficit repair contributions rather than what do we do about the big Section 75 number if we were to sort of think about restructuring or triggering. So I'd probably say that, but equally, I guess the unfortunate events which are happening related to COVID and pressure on businesses, cost pressure, sometimes leading to restructuring and or insolvency and that sort of thing, that makes it ever more important, I guess, for trustees faced with these sorts of situations to really get a good handle on which employers are liable under the legislation, because some trustees, understandably, in an ongoing situation where there's no real distress or cost pressure in the same sense that there is now, might be a bit more relaxed about having a really good, thorough understanding of that. But if you're talking about potential employer insolvency events and maybe PPF entry for some schemes, unfortunately, this is a dynamic situation. I'm sure there'll be more of that to come in the next 6 to 12 months. We're nowhere near, as you said at the start, there's more bad news every day, really, isn't there? In some respects, getting that stuff nailed down if you're ahead of having an insolvency event and understanding who your employers are, who the statutory employers are, and who isn't, you actually have a lot more opportunity to do stuff about that and clean it up in a complicated multi-employer structure pre-insolvency than you do post. Really, the worst thing you can do as trustees is not know about that until after an insolvency event's happened, because your options for sorting that out and safely guiding the scheme to the PPF, if that's the best outcome that's possible, are much more limited after an insolvency event. So it's sort of false economy to put it in the back of the cupboard, I think, actually, because it can cause you all sorts of problems.
Yeah, so I mean, potentially we may have a bit of a lull before the storm, and in the meantime, it makes lots of sense for trustee board to know what their rights and obligations are in the event of the various contingencies that may occur.
I think that's right. Yeah.
And I mean, it's just getting more and more complex, as a result of things like companies wanting to put off things like deficit repair contributions and balancing the interests of the sponsor with the interests of members. And then we've got, more legislation coming in force to try and promote company survival. I'm thinking in particular of the new Corporate Insolvency and Governance Act. On the horizon, a new funding regime, which could essentially make things more complex, because at the moment we have a bespoke regime, and in future we're going to have a bespoke regime and a fast track regime, and yet another pension schemes bill in the pipeline. So maybe just a final word from you, Graham. I mean, you've sort of stressed at the moment that in your view, the lay trustee is a very, very important component of the trustee board. But are the days of lay trustees numbered, just because it's going to be so hard to get people to be able to come on board and act as a member nominated trustee, with so many things that they need to know about, and it seems in some ways that it's increasingly becoming the remit of professionals only. Do you see it that way, Graham?
Well, I would probably say hopefully not. Hopefully it doesn't come to that, but there's no doubt, John, that during these times it's certainly shone a light on the importance of having a good, strong governance for pension schemes. I would still argue, though, there is still relevance for lay trustees if they have the scope and capacity to participate. I think it's also useful for members, and given their perhaps knowledge of the company, there's a danger, of course, of conflict, but there's also that knowledge which is of good use to a trustee board. But yes, it's certainly a very challenging role, and it's not getting any easier.
Okay, just a final check of the Q&A box, and I see nothing else has come in. So I think, that just leaves me to say, thank you very much to all of our speakers, Angela Stokes, John Walters, and Graham Cunningham. Thank you very much for your attendance today. If an issue does come to you after the event, please feel free to get in touch, and we're happy to address any issues post-event. There will be another Future Influencers event next month, and our marketing team will send out details of that. So please keep an eye out for the date of the next event and the agenda for that. And on that note, thank you again for attending. Stay safe, and hopefully speak to you next month. Thank you very much.